The $10,000 number is a decoy. That is the number your bank wants you to watch. That is the number financial news channels talk about. That is the number printed on every single warning article about federal bank reporting. And while you have been watching $10,000, your bank has been running a completely different threshold on your account. A threshold half that size, a threshold that most Americans have never heard of, a threshold that has no legal requirement to be disclosed to you ever if you have withdrawn $5,000 or more from your checking or savings account at any point in the last 12 months. There is a meaningful chance a flag was placed on your account the same day. Not a federal flag, not a government flag, a private flag filed internally by your own bank that feeds directly into the same federal database that tracks drug traffickers and money launderers. And you were never told. You will never be told. Because your bank is not legally required to tell you, and because telling you would cost them the very tool that makes that system work. This is not a warning about something that might happen. This is a description of something that is already happening. It is happening in every state. It is happening at every major American bank. It is happening to retirees who have done nothing wrong, who have banked at the same branch for 30 years, who have never missed a payment and never bounced a check. It is happening to people exactly like you right now this week. In the next 20 minutes, I am going to show you the real threshold your bank uses to flag your account, the number your bank has never once mentioned to you. The legal reason that number can be as low as $500 with no floor at all. The 7 specific withdrawal and deposit behaviors that most retirees do every single month without realizing they are triggering an internal review. Why the $10,000 number you have been told to watch is almost completely irrelevant to what is actually being done to your account, and the 5 moves you can make this week that stop the flags before they start. If you have a checking account, a savings account, or a money market account at any American bank, watch this entire video before you make your next withdrawal. Before I get into the numbers, I want to tell you about someone I know. I'm going to call her Linda. Linda is 64 years old. She is a retired school librarian from outside of Dayton, Ohio. She worked in the same public school district for 31 years. She had a modest pension. She had a paid-off car and a small brick house she bought in 1998. She had a savings account at a regional bank where she had kept her money since her youngest daughter was in diapers. The balance was around $47,000. Linda was not wealthy. Linda was careful. Last spring, Linda decided to finally fix the master bathroom. The tiles were cracked. The vanity was original to the house. The contractor she hired gave her a quote of $8,200. Linda thought about financing it and decided against it. She had the money. She had saved it specifically for moments like this. So Linda drove to her branch on a Thursday morning and asked to withdraw $8,000 in cash so she could pay the contractor at the end of the first week of work. The teller took the withdrawal slip. The teller looked at the screen. The teller asked Linda to have a seat. Then a branch manager came out, introduced herself, and asked Linda to step into a private office. The manager asked Linda why she needed $8,000 in cash. The manager asked if anyone had told her to make the withdrawal. The manager asked if she had received any unusual phone calls or emails recently. The manager asked Linda if she had met anyone new on the internet. Linda is 64 years old, a retired school librarian, sitting in her own bank being asked if she had met anyone on the internet. She told the manager about the bathroom. She described the contractor. She gave the contractor's name, his company name, his phone number. The manager thanked Linda and told her the withdrawal would require a brief compliance review. Linda was told it would take a few hours. It took 2 full business days. When the funds finally released and Linda paid the contractor, she assumed that was the end of it. 3 weeks later, Linda received a letter from the bank. The letter told her that a suspicious activity report had been filed on her account with the Financial Crimes Enforcement Network. That report now sits in a federal database that will be cross-referenced against every financial transaction Linda makes for the next 5 years. Linda did nothing wrong. Linda is a retired school librarian who wanted to fix her bathroom with money she saved over 30 years. And what happened to Linda is not unusual. It is the ordinary, expected, designed outcome of a system your bank has been running on your account for years without telling you. And it started not at $10,000. It started at $5,000. Here is what almost nobody explains because almost nobody outside of bank compliance departments actually knows it. The $10,000 reporting rule that you have heard about is a federal law called the Bank Secrecy Act. Under that law, any cash transaction over $10,000 in a single business day triggers a mandatory report called a currency transaction report that goes directly to the Financial Crimes Enforcement Network. That report is automatic. It is filed whether or not your bank thinks anything suspicious is happening. It happens every single time, no exceptions. That is the rule everyone talks about. But that rule is not the rule that caught Linda. The rule that caught Linda is a completely different report called a suspicious activity report. And a suspicious activity report has no dollar threshold at all. None. A bank can file a suspicious activity report on a transaction of $500. A bank can file one on a transaction of $50. The decision to file is made entirely by the bank's internal compliance software based on whether the transaction matches a pattern that the software has been trained to flag. The bank is required to make that decision within 30 days of the transaction. The report goes into the exact same federal database as the $10,000 report. You will never be told it was filed. You have no legal right to know it was filed. And if any bank employee tells you a report was filed on your account, that employee has committed a federal crime called tipping off, which carries up to 5 years in federal prison. This is why your bank will never have this conversation with you, not because they do not care, because telling you is illegal. Now, here is the part that most people, including most financial journalists, do not understand. Every major American bank runs its own internal compliance threshold that sits below the federal $10,000 line. This internal threshold is set by the bank's compliance department. It is not a law. It is not a regulation. It is a business decision. And it changes from bank to bank and from account type to account type. For most standard retail checking and savings accounts in 2026, that internal threshold is somewhere between $3,000 and $7,000. For the majority of the largest banks in the country, the number that most consistently triggers an internal compliance review on a senior account is $5,000. Not $10,000, $5,000. That means a transaction your bank has told you is completely normal. A transaction that sits 40% below the federal reporting line you have been told to watch is already being scored, reviewed, and in some cases reported without your knowledge and without any legal requirement that you ever find out. The $5,000 line is the line your bank actually uses. The $10,000 line is the line they want you to watch, so you never ask about the real one. I want to pause here because this next piece of information is the one that changes everything about how you think about your own account. The Suspicious Activity Report system was originally designed in 1970 to catch organized crime. At the time, a transaction of $5,000 in cash was genuinely unusual. $5,000 in 1970 is the equivalent of roughly $40,000 today after inflation. The system was built to catch large and unusual cash movements, not the ordinary financial behavior of a retired librarian paying a contractor. But the thresholds inside bank compliance software have never been adjusted for inflation the way income tax brackets and Social Security benefits are adjusted every year. They have stayed exactly where they were set, while the cost of a bathroom renovation, a used car, a medical bill, a home repair has grown 3, 4, 5 times larger in real dollar terms. Which means in 1970, the internal bank threshold caught criminals. In 2026, the internal bank threshold catches Linda. Here are the 7 specific behaviors that most retirees do on a regular basis that trigger the internal $5,000 review at major American banks. I want you to listen to each one carefully because almost every retiree has done at least 4 of them in the last 12 months without knowing it. Behavior number 1 is a withdrawal or deposit that breaks your historical average by more than 50%. If you have been withdrawing $500 a week for the last 8 years, and this week you walk in and ask for $5,000, the software flags it immediately. Not because $5,000 is illegal, because $5,000 is different from what you always do. The system does not know why you need it. The system does not care why you need it. The system only knows that you behave differently and different behavior gets flagged. A retiree who withdraws $2,000 every month to cover bills walks in one Thursday and asks for $6,000 to pay a contractor. That deviation alone is enough to start a compliance review. Behavior number 2 is a cash withdrawal made at a branch location you have never used before or rarely use. If your home branch is in the suburb where you live and you make a $5,000 withdrawal at a downtown branch while you are running errands, the software logs it as an anomalous location event. Third-party branch withdrawals on large transactions are reviewed at a significantly higher rate than home branch transactions. Behavior number 3 is a series of withdrawals spaced close together that when combined would have crossed the $10,000 federal threshold. 2 withdrawals of $5,000 in the same week. 3 withdrawals of $4,000 over 10 days. The compliance software now runs pattern detection over rolling 90-day windows. If it calculates that your recent withdrawal pattern adds up to an amount that looks like it was designed to stay below $10,000, you are flagged not just for the suspicious activity report, but potentially for a separate and much more serious federal felony called structuring. Structuring is defined under Title 31 of the United States Code, Section 5324, as the intentional breaking of transactions into smaller amounts to avoid the federal reporting requirement. The maximum penalty for structuring is 5 years in federal prison and forfeiture of the entire amount, even if the money is completely legal. The structuring law has destroyed the lives of innocent Americans who simply thought they were being careful with their money. A family grocery store on Long Island had $446,000 seized because the owners made deposits just under $10,000 to stay within their insurance policy's on-premises cash limit. They never committed a crime. The money was taken under civil asset forfeiture, which does not require a criminal conviction. The government does not have to prove you did anything wrong. You have to prove you did not. And while you are proving it, the money is gone. Behavior number 4 is a round number withdrawal of $5,000 or exactly $7,000 or exactly $9,000. The compliance software is specifically trained to watch for round numbers that sit below common thresholds, because round numbers in unusual amounts are the behavioral signature of someone trying to avoid triggering a report. The tragic irony is that the very act of trying to be careful, withdrawing a round number that you feel comfortable with, is exactly what the algorithm is trained to find. Behavior number 5 is a withdrawal made on the same day a large deposit lands in your account. If your required minimum distribution from your retirement account deposits on the 5th of the month and you make a cash withdrawal on the 6th, the software connects those 2 events. A large inflow followed by a same-day or next-day outflow is a flag pattern regardless of the amounts involved. Behavior number 6 is a cash transaction where you have not completed updated Know Your Customer documentation with your bank in the last 2 years. In 2024, federal banking regulators issued updated guidance that required all major banks to refresh customer identity verification on accounts that had not been updated since before 2022. Accounts where that refresh has not been completed are subject to higher scrutiny on all transactions above $3,000. If your bank has been sending you letters asking you to update your information and you have not done it, your account is currently in an elevated review category and you likely do not know it. Behavior number 7 is any cash transaction processed by a teller who is newer than 18 months at your branch. This one surprises people. New tellers are required by federal training guidelines to flag a higher percentage of transactions for supervisory review as part of their compliance certification. An experienced teller who has processed your withdrawals for 6 years knows you. A teller who has been at the branch for 4 months does not know you and is required to treat your transaction with the same scrutiny they apply to a stranger. If your regular teller is out and a new face processes your $5,000 withdrawal, the probability of a compliance review starting that day is significantly higher than if your usual teller had been at the window. Now stack those 7 behaviors on top of everything else your bank already knows about you. Your age, which is in your account profile, your income sources, which they can see from your direct deposits, your stated retirement status, which puts you in the demographic most commonly associated with elder financial exploitation in the bank's training data. Senior accounts receive more compliance scrutiny across the board than working age accounts at every major American bank. Not because seniors are suspected of doing anything wrong, because federal guidance from the Financial Crimes Enforcement Network specifically identifies senior Americans as a high-risk category for elder fraud, which means the bank's compliance obligation is higher on your account and the threshold for filing a report is lower. The system that was designed to protect you is the same system that is generating reports on you for withdrawing money to pay a plumber. And there is one more layer that almost nobody is talking about. The suspicious activity report filed on your account does not just sit in a database and wait. It feeds into an artificial intelligence scoring system called FinCEN's analytics platform that connects your banking activity to your credit card transactions, your digital payment history through Venmo and Zelle and PayPal, and in 2026, your cryptocurrency transactions through a new form called the 1099-DA that every major crypto exchange is now required to file. Every piece of your financial life is now in the same system. A suspicious activity report filed at your bank gets cross-referenced against your Zelle transfers, your PayPal activity, your Amazon purchases, and your investment accounts. The system is not looking at one transaction. It is building a portrait of your entire financial life and scoring it for anomalies. And if your portrait scores above a certain threshold, a human reviewer looks at everything, all of it, not just the transaction that started it. Here is what you do about all of it. Because everything I have shown you so far is the reason this channel exists. Not to frighten you, to give you the exact tools you can put in place before the next time you need to move your own money. Protection move number 1 is to pre-notify your branch before any transaction over $4,000. This is the single highest leverage move available to you, and it costs nothing and takes 5 minutes. Before any cash withdrawal, deposit, or transfer of $4,000 or more, call your branch manager directly. Do not call the main number. Call the branch. Tell them what you are doing, why you are doing it, and ask them to make a note in your customer file. When the transaction hits the compliance software, the note is visible to the human reviewer. Flagged transactions with pre-existing notes in the file are resolved without a suspicious activity report at a dramatically higher rate than flagged transactions with no documentation. The currency transaction report over $10,000 still gets filed automatically, and there is nothing you can do about that. But the suspicious activity report is a judgment call, and documented intent changes that judgment. Protection move number 2 is to build a paper trail before the money moves, not after. If you're about to make a large cash withdrawal to pay a contractor, write down the contractor's full name, their company name, their phone number, the amount owed, and the date of the transaction before you go to the bank. If you're withdrawing money to buy something, save the advertisement or the listing. If you're withdrawing money to give to a family member, write the amount and the purpose in a dated note to yourself. When a suspicious activity report is reviewed by a human compliance officer, contemporaneous documentation is the single most effective tool for stopping the report from triggering a federal referral. If you cannot produce documentation, you are relying on the reviewer to take your word for it. A piece of paper beats a verbal explanation every single time. Protection move number 3 is to move large transactions out of cash and into wire transfers or cashier's checks when the option exists. The suspicious activity report framework was built primarily around cash. Wire transfers and cashier's checks run through separate compliance systems with different flag parameters and significantly lower false positive rates on senior accounts. If you're paying a contractor $10,000, ask if you can wire it directly to their account or pay by cashier's check. Most contractors prefer it because it eliminates their own cash handling obligation. Most car dealers prefer it. Many home service providers prefer it. You eliminate the cash compliance flag and the recipient eliminates their own federal Form 8300 filing obligation. Both of you come out ahead. Protection move number 4 is to update your Know Your Customer documentation with your bank before you need to make a large transaction. Call your branch, tell them you want to schedule an appointment to refresh your account documentation, and come in with your government-issued photo ID, a recent utility bill, and your social security card. This moves your account out of the elevated review category and resets your compliance baseline. Do this once every 2 years and your account stays current. An account that is current in the system is treated differently than an account that is flagged for outdated information at exactly the moment you need to move a significant amount of money. Protection move number 5 is to open a second account at a different financial institution and route large one-time deposits to that account, not to your primary checking. When your required minimum distribution arrives, when a life insurance payout lands, when an inheritance distribution hits your account, that large unexpected deposit will trigger a compliance review at your primary bank almost every time. If instead it lands at a second account you have opened specifically for large inflows, the deposit does not disrupt the clean pattern at your primary account. Your primary checking stays quiet. The new account is expected to receive a large deposit because you just opened it and told them why. 2 clean accounts are dramatically easier to manage from a compliance standpoint than one account that is trying to handle everything. This is the move that most financial planners make for their own money and almost never explain to their clients. Linda eventually took the steps. She pre-notified the branch before her next large withdrawal. She built a document folder on her kitchen counter with a running log of every transaction over $3,000, the purpose, the recipient, and the date. She opened a second account at an online bank for unexpected large deposits. The next time she needed to pay a contractor, she called the branch manager first, walked in with a printed copy of the invoice and the contractor's license number, and made the withdrawal in under 10 minutes with no compliance hold, no private office, no questions about the internet. She told me the thing that surprised her most was how ordinary it felt. Like the version of banking she thought she had always had. The version she actually had before the rules changed without anyone telling her. The number you need to take away from this video is $5,000. That is the line above which your bank's internal compliance software is almost certainly watching your account. Not 10,000, 5,000. Anything above that number deserves a phone call to your branch manager before you move it. Anything above that number deserves a paper trail before it moves. Anything above that number is worth the 3 minutes it takes to protect yourself from a federal database entry that will follow your financial life for the next 5 years. The bank is not going to call you and explain this. The government is not going to send you a letter about this. The only person who can decide to take the 5 protection moves is you. If this video helped you understand something about your account that your bank has been keeping from you, Share it with one person you know who is over 60 and still keeps most of their savings in a single checking account. That one share might save them a 2-day hold on a withdrawal they needed today and a suspicious activity report they will spend the rest of the year not knowing exists.